What happens when public companies stop treating crypto as a fringe investment and start making it their core business strategy? We're already seeing that story unfold with a fast-growing trend that's reshaping crypto markets in 25 and now again in 2026. The rise of digital asset treasury companies, or DATCos for short. Simply put, DATCos are publicly listed firms that hold huge amounts of cryptocurrency, for example, Ethereum or Bitcoin, directly on their balance sheets. They offer investors a regulated, audited way to gain exposure to crypto. In other words, you can get exposure to the profit potential of crypto like Bitcoin or Ethereum without having to worry about owning the tokens and coins themselves. And the companies in question don't just hold the crypto, they actively use it to generate their own profits. Here's how it works. A DATCo raises capital in public markets, then uses that capital to acquire crypto. That crypto becomes the core of the company's business. The organisation might earn revenue from staking, lending to institutions, or structured trading strategies. And of course, if the value of the crypto rises over time, that's another potential source of profit. This means a DATCo's ability to reward shareholders and survive depends on two things: the long-term price action of its digital assets and the company's internal strategy for managing its treasury. Here's an example. If a company buys Bitcoin at $85,000 and the price later rises to $100,000, it hasn't sold a single coin, but its balance sheet is suddenly stronger. That stronger balance sheet can translate into value in several ways. First, the company itself becomes more valuable. The stock market may price its shares higher because each share now represents more crypto exposure than it did before. Second, a higher asset value gives the company flexibility, the ability to raise new capital because it looks like a more promising company, refinancing debt, or fund operations without selling at the wrong time. And in some cases, when gains are realised, i.e. when they sell off the crypto for more than they bought it for, companies may return capital to shareholders through dividends or buybacks, which in turn makes it a more appealing company to buy into and might get more investment. This is how digital asset companies make their profits. Okay, so that's how DATCos work when things are going well, but what about when the crypto market crashes? When crypto-heavy balance sheets fall, pressure can build fast within these companies, and they have some unique risks that you have to be aware of. Imagine a digital asset company that raised capital near the top of the cycle, issuing shares in debt when Bitcoin was $85,000. And they used that money to buy 10,000 Bitcoin. On paper, the balance sheet looked strong, until Bitcoin fell to 50,000. Suddenly, the company has lost $350 million in asset value, even though it hasn't sold a single coin. Meanwhile, fixed costs like employees, infrastructure, interest payments, they don't go away. Selling now would lock in the losses, but they still need to pay those bills. Investors notice. The stock begins trading below its net asset value. The stock market isn't just pricing Bitcoin anymore, it's pricing the risk that the company may be forced to sell its crypto at a loss. Raising new equity becomes expensive. Debt becomes harder to roll over. Management faces tough choices. Sell at a loss, issue new shares and dilute shareholders, which will piss them off in turn, or cut costs and ride out the storm. So to summarise, digital asset treasury companies are not trying to predict every tiny market move. Instead, their strength lies in structure, strategy and disciplined management of their crypto balance sheet, even as things are volatile outside the company. In this Wikipedia article, we'll take a closer look at the largest DATCos in 2026. Which ones held up during the crash and which ones are being put to the test.